Thank you all for joining us. I think this is going to be a really interesting and insightful conversation. Now we've got the systems working. We're going to be talking about the FTX collapse today. So what failed, what didn't fail, and what the impacts are going to be going forward. Now, my name is Sybil Williams. I look after marketing here at Rush. And for those of you who don't know, Rush is an award-winning Australian fintech with a unique platform that uses physical assets, so gold, as a digital currency. We're currently deep in the development of our next generation Rush Pro app, where we'll be adding other physical assets to the platform, along with some groundbreaking financial products that are going to allow investors to take those assets and use them in new and innovative ways. Now we're joined today by Mark Pay. Mark is director and co-founder of Rush, and Mark has spent his whole career at the nexus of technology and finance. So he's got some great insights into the regulation of financial markets. And we're also joined by Gavin Greenstone. And Gavin is one of Rush's subject matter experts on all things blockchain and decentralized finance. And he's been instrumental in helping us understand the current climate crisis, but also helping us develop our own product suite going forward. So let's kick off with a very basic question. Mark, what was FTX?
Yeah, thanks, Sybil. I appreciate that. I think I'd just start that at Rush Gold here, we are, specialists in digital asset technology. And so we've followed this space and followed certainly this latest news. So there's a lot of information coming out. It's an evolving situation, but we do know quite a few things about FTX now. The saga started really with the creation of a hedge fund called Alameda. And they went out to investors saying that they could provide 15% risk-free return. That didn't get a lot of traction. So they said, well, let's, start this exchange, which is called FTX. And now the FTX business and the Alameda business started with some relatively lower risk transactions. They were buying Bitcoin in the US and selling it in South Korea and things like this and back and forth. However, over time, the edge, the profits that they could make by doing that were dwindling. So they really said, well, let's open an exchange. We'll use it as a place to generate and raise capital. And they also had their own token. So the equity, essentially equity ownership of the exchange and the FTT token. And then so over time, they started moving capital in between FTX and Alameda. This created the illusion of a diversified equity balance sheet. They then used that, let's call it illusory balance sheet, to borrow funds that they, were able to, use to create leverage. And it was marketed and endorsed by some high-profile celebrities as a safe place to store and use funds. So I think that's kind of the initial, structures that we see out there. Now, there are sort of a number of phases here. So there was the setup, which we just talked about. There was the collapse. There was what you call the bank run. There was the hack, and we talk about that. Then there's the contagion and the fear going forward. So I think it's kind of got all those elements to it, and we'll get into that a little bit.
And Gavin, did you want to add anything about kind of FTX?
Yeah, I think it's interesting that FTX and Alameda were, for 5 years, I think, seen as very net positive for the industry. I mean, they invested in a lot of DeFi projects. And FTX as an exchange offered a lot of really innovative products, industry-first derivatives, options. They did leverage tokens. They worked with Fireblocks to deploy real-time confirmations of people depositing assets. And I think that they had a lot of trust within the industry and the community. And then I think that started to break down. There was a debate between SBF, who was the founder, and a guy called Eric Voorhees, Sam Bankman-Fried, and a guy called Eric Voorhees, who, and that debate was on the merits of decentralized finance and legislation. And I think in that talk, it came out to a lot of people's surprise that SBF was actually quite pro-regulation, that would have actually been quite restrictive on decentralized finance. And a lot of the people that had seen him as a kind of a champion, lost faith in him. And then, a couple of weeks later, with a Coinbase expose, it led to this dramatic 72-hour downfall of this massive empire, basically.
Yeah, well, I mean, that's really interesting. Innovative company, innovative structure, but something went wrong. So what actually failed, Mark?
So, I mean, I think one of the things that people need to come away from this is understanding when they have counterparty risk and when they don't. So as an example, if you hold you're the sole holder of encrypted key pairs on the Bitcoin network, you hold them on a device you control, whether it's a laptop or a USB key, you don't have counterparty risk. When you are the owner of physical gold metal, you don't have counterparty risk. When you're dealing with a centralized exchange that's a custodial exchange like FTX was, you do have counterparty risk, and people need to understand that. Now, I think the other thing people need to understand is not just that fact of centralized trading on an exchange, but the fact that these crypto exchanges are not regulated for what's called exchange conduct. Yeah? So you'll see exchanges that say, well, we're fully regulated. Well, what they mean is that they are regulated by the only regulations that cover them right now, which is typically AML and KYC. Now, when you talk about exchange conduct, is what is an exchange that holds your asset? What are they allowed to do? So it's not just use of customer funds. That seems the obvious thing. They cannot use them, to make side investments or to buy real estate in the Bahamas. That seems obvious. But there's a whole slew of other activities that are regulated as exchange conduct. So front running is an example. If you're about to do a big trade, the exchange is not allowed to do a trade right before you because they know your trade will make the market go up. They're not allowed to do trades at all with affiliated partners. They're not allowed to do what are called wash trades, which is two trades that are essentially mirrors of each other, just go back and forth. So you can say, oh, look at all the exchange volume. And then they're not allowed to do something that's called spoofing, which is to place an order with no intention to fill that order, just pull it, but just to try to move the price in one direction or another. So these are, as the Monetary Authority of Singapore stressed yesterday, these are unregulated exchanges for exchange conduct. Now, where was the regulatory failure? There's been a lot of discussion. There's been a kind of lot of revelations about how the regulator failed. I guess I'd say that the regulator failed by just going extremely slowly with regard to, number one, understanding what these new, what this new asset class is all about, and then number two, defining it for the various providers. So as a result, you have people that are hopping around to jurisdictions, people, when I mean companies, that are hopping around to various jurisdictions and saying, oh, we're going to plant here because these guys haven't regulated yet, or we're going to plant here. Even, the biggest exchanges, the crypto exchanges in the world, Binance, they started in China, and then they moved to Japan, and then they're Hong Kong, and then they're sort of, well, we don't have a headquarters. So how did the regulator fail? I'd say there are quite a few things coming out about what the SEC, particularly in the U.S., did or didn't do. The SEC in March of this year issued a no action letter and said they couldn't find anything wrong. But by the same token, you had 8 congressmen pressuring the SEC to stop investigating them. So I think there are a lot of questions still about regulatory failure. And I think, unfortunately, you have to ask about what was happening with regard to regulatory capture. I understand that private messages between the chairman of the SEC and Sam Bankman-Fried are now going to be subject to a subpoena. So I think we need to find those things out. The last thing I'd say, I think about kind of the regulatory part is this is sort of being tried in the press, been trial by jury, like what happened. And it's very disturbing for me to see a Wall Street Journal article yesterday about Sam Bankman-Fried's philanthropy. Well, that's not the important thing. That's philanthropy with stolen funds. He's admitted that these are stolen funds. He's going to speak at a conference in New York next week, sponsored by New York Times. I mean, I just don't see that those types of things are appropriate. The other failure I think I'd point to is institutional due diligence failure. So you had some of the most prominent venture capitalists and investment funds in the world that had publicly made very large investments into this company. And they apparently did so despite the fact that the company had no board of directors and no internal accounting control. So now that has to come out in court filings and say they, they used emojis to confirm transactions. I mean, it's just shocking what has come out. But you had very big names that essentially put their brands on this. That includes the Government Investment Fund of Singapore. So I think there are a lot of questions to be asked there. You had some really high profile, sports stars and things like this. There's now a $750 million class action lawsuit because they put their names on this. So I think there are plenty of questions to ask about the kind of sort of cascading failures. Yeah,
absolutely. So that's named a lot of things that did fail. What didn't fail? Gavin, what didn't fail?
Well, what didn't fail is blockchain technology. I mean, that is proven to be absolutely robust. So a failure of blockchain technology would be a Bitcoin double spend, for example, or if someone managed to hack someone's 24-word seed phrase, which secures their wallet, or if someone managed to break the cryptography and counterfeit a token and have another protocol think that you had someone else's token in your wallet. Those things didn't fail. So the technology there has remained incredibly robust and to this time, has proven to be 100% trustworthy. And the other thing that really didn't fail, in fact, it's come out like a shining light in all of this, is decentralized finance. I mean, decentralized finance is working, and it's proven to be stronger in many ways than its centralized finance counterparts, which they can be corrupted by humans, even in a regulated environment. Whereas code that is well written, has been audited publicly, is transparent. If the code is good and accepted, you can't beat it. It's a mathematical certainty that the code will execute with finality in the way that it's programmed to do every single time. I think what we're learning from this is that these decentralized finance protocols probably need better UX systems so that they're more accessible to the public. But they've proven to be very resilient. I mean, for example, like following the FTX blow up, in the 10 days, I think we saw about $6 billion, $5.5–6 billion flow out of centralized exchanges. People pulled their money out of exchanges. And we also saw tokens that were linked to decentralized exchanges go up about 34% in value, whereas sex baskets went down about 4.6% all up. So we've seen a general move within the community of acknowledging that decentralization works, and these trusted centralized systems are more fallible. So yeah.
Okay, so if blockchain didn't fail, DeFi didn't fail, both of them still really strong, what does that mean for us going forward? Where to from here?
Well, I think there's going to be a setback, because it's quite, we talk about mass adoption, happening where blockchain moves to the masses. And one of the places that people could trust where to keep their Bitcoin was places like FTX. I mean, you had stadiums in America with massive FTX billboards. You had, as Mark said, sports celebrities endorsing them. So people who weren't comfortable with self-custody solutions, it's a little bit difficult for them. They're a bit in no man's land now. They're not comfortable with self-custody, but they don't want to trust the exchanges. I think we're going to see a lot of solutions coming up really quickly. We're reading about some banks around the world that want to start offering custody of Bitcoin and Ethereum. Personally, I don't really love that example, but, a lot of people will like it. And then we're seeing things like PayPal and Twitter starting to say they're going to move into the digital payment space. And, we've got Jack Mallers' Strike, which is going to build payment rails of that. So people will eventually be able to buy and sell crypto without having to manage a seed phrase, which they then have to store securely, and all of that stuff. But I think what's really interesting as well is what we saw like 2 days ago. Blockchain Australia put out an announcement that they are working with leading exchanges to provide more transparency to the industry. Like, what they're realizing is that if they want to bring trust to the community, they need to be more transparent about their operations. And that includes, showing proof of reserves, which show that people's, exactly what their assets and liabilities are. And also showing that they do not they do not actually have the ability, let alone the right, to actually use those assets. So there's custodial systems like Fireblocks which can be integrated in, which may work towards allowing people to bank their digital assets with these exchanges without the exchanges actually being able to access them. And then I think, we'll see a bigger adoption of decentralized finance as people start to realize that they can trust mathematical systems. We trust 2 + 2 = 4 better than they need to trust the word of whatever system investment sort of vehicle they're choosing to use. And, and then finally, moving forward, which obviously relates very much to Rush, is we're very excited about what we see is going to be the integration of real world assets into decentralized finance. Because by integrating the ownership of a real world asset, not the asset itself, but a verifiable, publicly accepted, trusted ownership certificate, that is going to enable us to use these assets into these new decentralized and centralized finance applications, and that's going to be able to allow us to bring a lot of new and exciting products to the market, including but not limited to lending and borrowing and derivatives trading, all that sort of stuff.
So we're going to take significant friction out of the system.
Yes, because for a lender, if they know that they can lend money out against an asset that is, the ownership is recorded on a public blockchain, and there's an immutable code in place that says that if the debtor defaults on the loan, that the ownership will be transferred to the lender. Yeah. Then they can save money on legal costs and setting up a whole lot of basic, not just legal costs, but it just becomes, there's more certainty around the process, which should benefit everyone. They should be able to pass on cheaper lending rates, which we're seeing in DeFi at the moment. I mean, you can borrow USDC against your Ethereum at the moment. I don't know the exact amount, but it's about 1.6%. You can borrow against that, and it's very hard for centralized finance to match that.
Yeah, absolutely. So, Mark, looking forward, anything to add to that?
Sure. I mean, I would echo a lot of what Gav says. I think he's absolutely correct. I think when you talk about transparency for centralized exchanges, where we know that they have the assets that they say they have on their books, it can't just be, I declare, yes, it's true, I have my hand up, blah, blah, right? And we're really asking any centralized exchanges to conform to something that we already expect for something like the ASX or the NASDAQ. So to be an over-the-counter clearing participant on the ASX, you need tier 1 capital of $50 million. Right, so there is a level of certainty. There's a legal framework around the operation of the ASX. We're really saying that if you're going to have to trade on a centralized exchange, if you want to use a centralized exchange for convenience or speed or depth of order book or any of those things, that that they really should have those types of basic protections. Is the the use of the customer funds, is the asset there, and what's the solvency of the exchange. Now, I would say that there is, I want to make sure we have what I'd say is a super positive note about this, that the potential in the future is that you have sort of the best of both possible worlds. You have absolute certainty about the individual outright ownership of a real world asset, married with the idea that in a decentralized exchange format, you have certainty about how that is exchanged for other assets. So we don't have to really rely going forward on these centralized exchanges. To the extent people are relying on them, I think we have to worry about, excuse me, we have to worry about consumer harm. So I think FTX US had something like 85,000 customers. FTX Australia had 88,000. So, this is very much front of mind for people here. We are for situations where consumers can be protected. And so if they have to be protected through legal means and through the courts, we see all that's going on with the courts right now. But really, the exchange conduct that is represented by computational mathematics in a DeFi contract doesn't need a legal system, because it's essentially, it's a set of parameters by which the transaction will take place. So we think there is this fantastic opportunity for that combination of real world assets on public blockchains, but then exchanged in a DeFi contract. Now, marrying of tech with regulation, we're not in favor of more regulation for regulation's purposes. In our case, outright ownership of physical gold bullion is completely settled in terms of legal and regulatory. It's property. We look forward to other assets that are similar that'll be on the Rush Gold Pro app, especially Rush Gold Pro app, and then the ability, as Gav says, to use those in ways that blockchain and finance and DeFi has enabled them to be used as collateral for lending. Can they be lent out themselves? So we think the future is incredibly bright. This is a bump in the road. I think it's going to bring a lot of clarity forward, which is good. It was well overdue. I think there were a lot of questions that people refused to ask in crypto world, and I still think there's a lot of mileage to go. One of the things we don't know in the current situation is how much contagion there still may be from this. I think FTX had 130 plus corporate entities. They had funded projects. Those projects were under NDA. So I think there still is a potential for contagion going forward that we just don't know about. It's a bit like in Lehman Brothers. You just didn't know where the leverage was, and that has to be sorted out over time. But I think I'd say, that overall it's a very, very positive, note going forward, because this is going to give some clarity of what do I own, what's the nature of the asset I own, and then what's the nature of the places that I can exchange that for other asset. And if people really focus down on that, it's not just about speed and convenience, depth of order book, and instant, like selection of 150 different cryptocurrencies. That shouldn't be, really the focus going forward. It's great for a big percentage of the marketplace that want to do it that way, but they should be extremely aware of the custody risk and the solvency and the counterparty risks that they take over there. Yeah.
Okay. Well, I mean, it sounds like it's an exciting time. There's a little bit of uncertainty still, but there's lots of interesting and positive developments coming up. I think this has been a fascinating discussion. I sit here with my head nodding the whole time. I'd really love to open it up and see if there are any questions from the audience. There is a Q&A section in here. So if anyone has any questions, would like to pop those in the Q&A, feel free. We already have one. So here's a question from our audience. Do you see real estate ownership as an example of what could be included? Mark.
Absolutely.
Oh, Gavin, you go first.
Absolutely. But, we just got to get the regulator in America behind that. But Mark, over to you.
I actually looked at this number of 5 or 6 years ago and saw what some of the blockers are. I think the land title systems in different countries have all different parameters to them. And I think you'd have to ask if you have a certificate of title, is that represented by a digital certificate of title, and do they have equal legal standing with regard to your ownership of that block of property? So I think it would need even more participation by regulators and by the legal system for that to become a reality. I think when you think of real assets, you do think of real estate. In our case, we think there are some very, extremely well-defined real assets that are highly valuable investment assets And we look forward to having more of those available, individual outright ownership on the Rush Gold platform. So I think real estate potentially super exciting. There is a company in I think based in Sydney that's called Bricks that can sell fractional shares, but that's in more of a traditional share market type of legal setup. So problematic, but promising is what I'd say.
Yeah, it's problematic because you're also dealing with places where people live. It's one thing to lose your Bitcoin or have it move on a chain, but to have the home where people are actually living obviously creates a unique.
Well, somebody could rock up with the asset on their phone and say, "Sorry, you're evicted now." No, we don't want that.
But it would allow exciting things like the ability to fractionalize a skyscraper into 10,000 bits and sell parts of them off like shares in that thing, or being able to bring in new lending products to borrow against it, for example. But you'd need to have integration with the government systems basically as well, who would recognize that blockchain ownership. Yeah.
Pay stamp duty on a brick.
Yeah.
Okay, second question. Maybe this one, I don't know who wants to answer this one. Why hasn't the regulation been enacted properly? Gavin, is that you?
Yeah, it's an interesting one. So, we don't want the regulation to move too quickly because the laws were constructed around assets that they understood. Now, I've seen a lot of debate in the last couple of years, is a cryptocurrency an asset or is it a security? And that has been a blocker to regulating it. Just last week, I was reading something interesting, like there was moves by Polkadot, which is another very famous cryptocurrency, to say, no, they are not an asset and they are not a security. They are actually software. So now they're trying to classify their token. It's actually a piece of software. So I think, the regulation, good regulation that will encourage innovation, that's, comes with a fair taxation system, obviously, behind it, needs to understand these assets, and they are evolving really, really quickly. But I think what's important is that the regulators approach it with an open mind and also a basic understanding of certain human rights, which, a lot of people believe that the right to transact between two individuals is a basic human right, and is always looking to maintain those and try and understand what this new asset class is and not try to fit it into existing regulatory frameworks.
Yeah, I'd just jump in and amplify that, maybe challenge some of it. I think the SEC has been rightly criticized for doing what's called regulation by enforcement. In other words, not coming with comprehensive regulations and then selectively saying, well, that one is under this one, and well, that one is under this one. So they had a high-profile lawsuit, I think it's still going, with Ripple in this regard. They recently went to a project called Libri, LBRY, and they said, oh, you are a security. Now, they were criticized for that because Libri is a tiny project, and the SEC knew they would not mount a very large legal defense, number one. Number two, then they could point to it as a precedent. Now, what Libri does is very similar to what a very large percentage of other cryptocurrency, tokens and platforms do. So that's a bit worrisome. So I don't think it should be regulation by enforcement. I think people need to buckle down. I think they need to dig in to understand these. You see real errors of fact in prominent regulators and their statements they've made. They just plain don't understand it. And I mean, I was 10 years at Microsoft. I understand a bit how the bits flow, but even then, right? And as Gav says, this is an innovative area, and there are brand new combinations of cryptography with humans on either side, wanting to own those bits of cryptography or not, and exchange those with other humans in a free and open market. And so I think I would fault the regulator for dragging their feet. I think we're not in favor of more regulation just for regulation's purposes. It is one of the reasons that we have chosen to focus initially on fully owned digital physical gold bullion, and because the regulatory is absolutely settled in really every jurisdiction around the world. So that's the comment I'd make. I think the regulator needs to use this as a really an opportunity to step up and understand things. Yeah. And then come with a framework that protects consumers where they need protection, but leaves innovation alone to do what we can do.
Right. Okay. So what what is Rush doing in this area, and what's the impact for Rush?
Yeah. So, we actually in 2016 put the first working version of our platform on blockchain, and it was in production. And we really pulled back from it because a couple of different things. We saw, number one, that the regulatory was not settled, and this is an example of that. We also saw that the solutions around custody were not settled. Now that situation is really changing and really has changed. So for our customers, they want to, remain our customers as the individual outright owners of regular gold bullion and not touch blockchain in any part of what they do. We're happy, that's a fantastic part of our business, a growing part of our business. But we also do see the opportunity to use public blockchains as a system of record, because they then enable that physical gold bullion to be used in types of transactions, whether it's lending, it's borrowing, and pledging as collateral, things like this. So we think the future is very bright in that regard. We've got a great team internally. Gav's part of it. We've got some really leading people that are working on that with us. And so, bright future. And frankly, the macroeconomic situation around the ownership of some of these real assets out in the world is absolutely coming our way. In the macro banking world, you've got the yield curve inverted, and it's really a sign of some difficult times potentially ahead. And we think the outlook's really super positive. So let's get this regulatory uncertainty behind us. In our, with regards to how we go, we feel like, we've got an absolute handle on what the regulations say we can and can't do today. And that's always a bright line that we stay inside of. Yeah.
We're very excited to offer choice to the customers. So they're like maintaining direct title to gold, absolute outright ownership for the customer will always remain intact. And the bank grade ledger system that has been built over the last 5 or 6 years is intact, but allowing people the possibility of moving that title onto a public blockchain if they choose, and then back again, and then exploring some of these new financial instruments that we can introduce there. It's just a very exciting thing to do.
Yeah. Well, look, I think what we've covered is there is a huge amount of possibility, there is a huge amount of opportunity, and there's a lot that's going right. So even with all of the news and woes being talked about, we are really somewhere quite positive right now. So look, I'd like to thank you both. It was really fascinating, and thank you for all the questions. And we have recorded this session, so we will be putting this out. If you want to go back and rewatch any sections of it, we will be sending this out. So thank you, and I hope you have a wonderful Friday afternoon.
Thank you, Sybil. Thanks to all the attendees.